Hi class, my name is Bobby Stitt, and I hope you are all doing well with the semester finally winding down. For my intermediate microeconomics final project, I decided to take a look at policies towards protecting the environment. I am an environmental analysis and economics double major, and something I am becoming increasingly aware of are the economic impacts of natural resource protection. Given that I am already thinking about these topics, I thought it would make for an interesting area of study. I will briefly here discuss how I will go through the rest of my presentation. First, I will discuss what policies I will be examining through an economics lens. Next, I will define some key terms I will be using through this presentation. After this, I will look more in depth at each of the proposed policies. For each of these policies, I will both talk about them generally and similarly provide a walkthrough on how they impact the economy. After looking at these policies, I will give a brief summary, and hopefully you will walk away with a new understanding of natural resource policy. So I won't bother you with the intricacies of what the environment is or how protecting the environment is vital, as I assume that as 5C students you are generally aware of this. However, what you might not be as familiar with are the promoted policy tools to achieve this goal. In the interest of time, I decided to take a look at 3 policy instruments designed to protect the environment, each with unique economic implications. The 3 tools are taxes, subsidies, and permits. As we know, taxes are defined as a financial payment paid to the government to fund government expenses. Tax season is currently in full effect, so it might be useful to think of these as the payments you're making to the Department of the Treasury. Subsidies, by contrast, are financial breaks provided by the government. This is an important distinction because while taxes are paid to, subsidies are paid by a government organization. The last policy tool I will cover are permits, which, as you can read, are a right given to produce a certain amount of negative externalities. This might be a new concept, but I will elaborate on it later. Here, I wanted to define some terms useful in the examination of the economics behind some of these policies. The first 2 are private marginal costs and benefits. These are effectively just the supply and demand curves that we normally use. A private marginal cost is the cost associated with additional production, whereas private marginal benefit is the benefit you receive with additional production. This is helpful when looking at social marginal costs and benefits. A social marginal cost is the private marginal cost, but with additional external costs to the production of goods and services. Social marginal benefit is the private marginal benefit, but with additional external benefits associated with the production of these goods and services. This is easy to think about when looking at positive and negative externalities. A positive externality is when the social marginal benefit exceeds the private marginal benefit. Think of education. Education benefits the individual, a private benefit, as well as providing additional benefits to society as a whole, a social benefit. A negative externality, by contrast, is when the social marginal costs exceed the private marginal costs. So think of smoking cigarettes. Smoking a cigarette costs the individual, a private cost, but similarly costs the health around the smoker, a social cost. These might be a little confusing, but we'll see how they work a little later on. So let's take a look at the first proposed policy instrument, a carbon tax. Just a minute ago I covered the idea of taxes, but what exactly is a carbon tax? This form of financial payment to the government comes alongside carbon emissions. Effectively, it is a tax on how much you emit. If you emit $20, let's say, of carbon, a carbon tax of 10% would generate $2 in revenue. So now let's look at how this works. Here, I have already laid out a basic supply-demand graph for negative externalities, or in this case, carbon emissions. As described earlier, in the case of negative externalities, the social marginal cost exceeds the private marginal cost, with the benefits being the same. I should mention that the benefits are the same as there is no external benefit to carbon emissions. In the initial equilibrium, the price of and quantity produced is at the intersection of our private marginal cost and marginal benefit curve, so point A. Now let's think about what happens when we introduce a carbon tax. One of the takeaways of this course that Professor emphasized was the platinum rule. Find where marginal benefit equals marginal cost. The government applies this rule when considering the implemented tax. However, the tax is supposed to realize the full amount of costs associated with negative externalities. So the platinum rule would mean that the tax be applied where social marginal cost equals marginal benefit, at Q2. So what does this mean? At this new quantity, the price paid by consumers for carbon-related goods increases to P2, whereas the price received by firms decreases to P0. This means that there is a loss in consumer surplus, shown here, and a loss in producer surplus, shown here. The area represented by the product of the height of the tax, P2 minus P0, and the new quantity, Q2, will be the new government revenue. As we can see, the net effect of this tax is that the loss in producer and consumer surplus exceeds the gain in government revenue, meaning the economy will incur a deadweight loss. Now that we know why and how this policy impacts the economy, let's figure out some pros and cons to a carbon tax. A major benefit to this tax is that it will limit the amount of carbon-related emissions. The new high price will not only reduce the quantity produced and consumed of these goods, it will similarly offer incentives to consume alternatives to carbon goods. However, this benefit is not without its downsides. As we saw, this tax will create deadweight loss in the economy. Many are not too worried about this level of loss, as it can be offset by a reduction in other taxes, but it is still important to consider. Similarly, often overlooked is that those who will get hit the heaviest by this tax are low-income individuals. Why is this the case? This is because, as we saw, carbon-intensive products are going to be more expensive. Studies show that carbon-intensive goods are consumed in greatest proportion by low-income individuals. The effect of such a tax may, therefore, adversely affect those with lower incomes. So now that we have an idea of what a carbon tax is, let's move on to the second pollution-reducing policy tool. While a tax is a payment to the government, a subsidy, by contrast, is a financial break provided by the government. Subsidies could be used as a tool to fight pollution if they are placed on renewable or sustainable goods. That is, if it costs $20 for a sustainable light bulb, a subsidy of 10% will have a $2 effect on the price paid by consumers and received by producers. Now let's take a look at how this works. As we can see, this is a graph for positive externalities, or environmentally beneficial goods. As described, positive externalities means that the social marginal benefit exceeds the private marginal benefit, with costs being the same. I should mention that costs are normalized to be the same, as there is assumed to be no external costs to production of renewable goods. At no subsidy equilibrium, the quantity produced is Q1 and the price of goods are P1. Now let's think about a subsidy. The subsidy here shifts the supply curve to the right. Why is this? Well, with a subsidy, it is cheaper or less costly to produce a good, so supply shifts right. We can see here that this new price paid by consumers is lower than the old price, P2, and the new price received by producers is higher than the old price received, P0. This results in additional consumer surplus, shown here, and additional producer surplus, shown here. The product of the height of the subsidy and the new quantity is the payment by the government, as seen here. As we can see with this payment, the net effect when accounting for consumer and producer surplus is production inefficiency or a deadweight loss in the economy. So now that we know how a subsidy on renewable goods impact the economy, let's turn our focus to some pros and cons of this form of intervention. A major benefit for subsidies is that it encourages socially efficient activities. That is, with the new price, consumers are now paying a price that accounts for the full social marginal benefit. It is hoped that this action will reduce environmentally damaging activities and, in the long run, change consumer preferences. However, just as with taxes, this is not an economically efficient outcome, as there is a deadweight loss associated with subsidies. Governments pay for the subsidy, so this extra revenue would have to come from somewhere. Think maybe about that amount gained from carbon taxes. Similarly, while this benefits all, there is a general concern that subsidies will encourage inefficiency, known as market failure or government failure, and leave firms reliant on the subsidy. So now that we have examined subsidies on renewables, let's turn our focus to the final policy tool, permits. The final policy tool I will be looking at are tradable pollution permits, otherwise known as cap-and-trade programs. Permits set a limit on the amount of negative externalities of production. If a firm, therefore, ignores the negative externalities of production, it has to purchase more permits, increasing its costs. To avoid these costs, it is necessary for firms to reduce their emissions. So let's look at how this works. Again, like the example of a carbon tax, here we are dealing with negative externalities, pollution as a result of production. Therefore, social marginal cost exceeds private marginal cost, and benefits are normalized to be the same. At initial equilibrium with no permits, the level of production is at point A with price P1 and quantity Q1. When a permit is introduced, the quantity of pollution is therefore bound by this level of permits. Unlike a tax, where the price of the tax determines the quantity of pollution, a permit, which sets the quantity of pollution, therefore determines the price. Both policies work in similar ways and attempt to utilize the platinum rule of setting marginal social cost to marginal benefit. The price now faced by consumers is at P2. These programs are unique in their variable nature. Over time, producers' demand for pollution will decrease as they experience an extra cost for polluting. This shift left in demand to D2 is accompanied by the reduction in available permits. A decrease in supply as the result of a decrease in demand keeps the price for permits high and further decentivizes pollution. So now that we have seen how this policy works, what are some potential pros and cons to pollution permits? The main argument for is that it creates a market for these tradable permits. If a firm produces less pollution than is capped by the government, it can trade these permits and generate revenue. This will incentivize firms to invest in sustainable production as they can gain revenue for their investment. Creating a market for permits is seen as a strategic way to combine economic interests with environmentally friendly ones. However, there are some drawbacks to this policy. Just like carbon taxes, this policy raises the prices felt by consumers, disproportionately affecting low-income individuals. Similarly, it is argued that pollution is a tricky thing to measure, so setting a quantity of permits and measuring a firm's pollution will be difficult. In closing, we have examined 3 policy tools towards pollution reduction. Carbon taxes, high prices disincentivize environmentally damaging activities, yet come with deadweight loss and have a disproportionate effect on certain communities. Subsidies incentivize use of renewable goods, yet have an attached deadweight loss and may not be efficient. Permits offer a market for environmentally friendly outcomes, combining economic and environmental motives, yet are difficult to fully realize. What we know is that something has to be done, yet I am leaving it up to you all to give me an insight into the best practical outcome. This is a list of questions I had while making this presentation, and it would be wonderful to hear y'all's feedback on these, and anything else I neglected to include in this presentation. Thank you all so much for listening to me, and I hope the rest of your semester goes well.